What if I told you the biggest secret to building wealth isn't your salary, but your birth certificate? Seriously? Okay, let's dive right into this explainer and hand over the ultimate financial cheat code I really wish someone had given me years ago. Think of me as your trusted older sibling who figured out money the absolute hard way. I'm going to share everything I wish I knew back then, starting with the biggest lie we're all fed, that you somehow need to be rich or wait for the perfect time to start investing. Let's look at the story of two everyday people, Maya and Jordan. Maya started investing just $100 a month at age 25. Jordan decided to wait 10 years, starting at age 35, and also invested that exact same $100 a month. The result? A massive $375,000 gap in wealth. Those 10 extra years of waiting literally cost Jordan over $250,000. Maya only put in $12,000 more out of her own pocket over her entire lifetime, but she ended up hundreds of thousands of dollars ahead. Wild, right? So the ultimate takeaway here is incredibly simple. Time is a far more powerful force in investing than the actual amount of money you start with. The market honestly does not care about your salary at all. It only cares about when you enter the game. Let's actually break this down using an amount pretty much anyone can scrape together. Just $100 a month. If we look at the historical 10% annual return of the S&P 500 and you invest just $100 a month, after 10 years you'd be sitting on about $20,000. And the amazing part? Only 12 grand of that is money you actually contributed from your own pocket. You are already winning. Now, fast forward to year 20 of investing that exact same $100 a month, and suddenly you're looking at approximately $76,000. That snowball is picking up serious speed now, rolling so much faster as it goes. And this brilliantly illustrates the magic of compounding. By year 30, that simple $100 a month habit snowballs into a whopping $226,000. Notice how the gap between what you contributed and what the market earned for you is just exploding? Your money is now working way, way harder than you are. Finally, after 40 years, the math gets genuinely mind-blowing. You have turned just $48,000 of your own money into $637,000. Nearly 92% of that final balance is pure unchecked compound growth. You didn't work extra hours for that remaining 589 grand. Your money literally just multiplied itself while you slept. A really cool, simple trick to calculate this exponential growth right in your head is called the Rule of 72. Basically, you just divide the number 72 by your expected annual return to find out exactly how many years it takes for your money to double. Meaning, at a historical 10% return, your money naturally doubles every 7 years. And that happens without you adding another single cent. Okay, section 1, investing jargon translated. We're going to break down all that intimidating Wall Street vocabulary into plain English so you can actually get started. No more jargon, I promise. First up, we have stocks. Think of buying an individual stock like placing a massive bet on a single player. It's super exciting if they score and do well, but it is highly, highly risky. I cannot stress this enough. If that one player gets injured, gets into a scandal, or just flat out fails, you can lose your entire investment. It is a trap so many beginners fall into. An index fund, on the other hand, is like betting on the entire league all at once. Instead of trying to guess which individual player is going to win the MVP, an S&P 500 index fund gives you tiny pieces of the 500 biggest companies. We're talking Apple, Amazon, Google, all wrapped up in one incredibly simple, diversified investment. Next, we've got ETFs, or exchange-traded funds. Now, for a beginner, this is very similar to an index fund. It offers the exact same broad, low-risk diversification. The only real difference is that an ETF is traded throughout the day on the stock market, so you can buy and sell it any time during normal trading hours. But honestly, as a passive, long-term investor, that day trading aspect isn't something you ever need to worry about. We are here to set it and forget it. Finally, mutual funds. Buying a mutual fund is like paying a super expensive manager to try and handpick the best players for you. But here's the dirty little secret. These come with high fees. And research actually shows that, historically, they perform worse over the long term than if you had just bought the simple, cheap index fund yourself. All right, moving to section 2, free money and tax hacks. Now that you know the players, let's talk about the absolute best accounts to put your money into so you can legally avoid taxes and grab some free cash. This is the stuff that can literally shave decades off your working life. First up, the 401k. If your employer offers a 401k match, take it immediately. It is literal, guaranteed free money. Think about it. If your boss offered you a guaranteed 50% or 100% raise on a part of your paycheck, you would take it in a heartbeat, right? Well, that is exactly what a match is. Leaving that employer match on the table is the biggest, most expensive mistake you could ever make. Once you snag that free 401k match, the Roth IRA becomes your ultimate tax hack. Here's why. You put your after-tax money in, but all that compound growth, that massive snowball we talked about earlier, comes out completely tax-free in retirement. Compare that to a normal taxable brokerage account where the government swoops in and takes a cut of your earnings in the form of capital gains taxes every single time you sell. To make this absolutely foolproof, here is your exact cheat code blueprint, the 5-step order of operations you should follow to build an absolute financial fortress. Step 1, and this is your non-negotiable foundation. Save an emergency fund of 3 to 6 months so you never have to sell investments in a panic. Then, step 2, grab that free 401k match. Step 3, max out that tax-free Roth IRA. Moving right along to step 4, go back and max out the rest of your 401k. And finally, step 5, put any leftover cash you might have into a taxable brokerage account. So, how do you actually execute this today with just $100? Well, you can start with as little as $1 on apps like Fidelity, Schwab, or Robinhood by buying what are called fractional shares. You don't even need to buy a whole share. Just search for broad S&P 500 funds. And hey, while this isn't official financial advice, some great educational examples include VOO from Vanguard, IVV from iShares, or Fidelity's FXAIX and FCROX, which is totally amazing, by the way, because FCROX actually has a 0% expense fee. Oh, and a quick side note for our international viewers, the exact same principles apply globally. The math behind compound interest does not care where you live. Just do a quick online search for the best beginner investment platforms in your specific country to find your local equivalents. Once you buy that fund, the single most important habit you absolutely must build today is dollar cost averaging. That simply means setting up automatic monthly contributions so the money invests itself without you ever having to think about it. Automation relies on a rock-solid system rather than your fleeting willpower, which means you can actually live your life without stressing over daily market news. It completely removes human emotion from the equation. And speaking of emotions, as your older sibling in finance, I really have to warn you to avoid these 5 emotional traps that just ruin beginners. Number 1, trying to pick individual stocks before you even understand the basics. Number 2, panic selling when the market dips. Guys, you only lock in your losses. Number 3, waiting on the sidelines to perfectly time the market. Number 4, depending on your own willpower instead of just automating the process. And number 5, checking your portfolio every single day. Seriously, just set it and forget it. I'll leave you with this incredibly powerful truth. The market does not care about your income, your background, or your age. It only rewards one thing above everything else, and that is time. And the only possible way to get more time in the market is to start today with whatever you have in your pocket right now, even if it's literally just $50 or $100. If this explainer changed how you look at your money, please hit subscribe, because every single week we break down a new topic that will give you the direct cheat codes to secure your financial future. And I'll leave you with this final question. What is actually costing you more right now? The money you don't have or the time you are wasting by waiting? You've got this, and I'll see you in the next one.